These are the stocks that the market hates right now. So for reference, this is my portfolio. So I'll be covering some of my positions in today's video. The first stock that I'll be covering today is in the software sector, and this company is none other than Salesforce. So Salesforce year to date is down around 28%. It is currently trading at a 36 times earnings. So for Salesforce, what is wrong with the company? So first of all, Salesforce, as well as all your CRM providers like Workday, like Monday.com, they're getting hurt today after Monday's earnings because there's the perception that your AI revolution will disrupt the traditional CRM provider space. And besides that, Agentforce is also what the company is trying to push today. But a few things to note about Agentforce. Number one, it is still extremely small scale. They had around 3,000 paying clients in Q4 of their earnings report. Number two, Agentforce is expensive. So all your different small firms, they cannot adopt Agentforce. And the third concern, which is the biggest one, is that Agentforce is something that other companies can create themselves as well. So for all these different companies, if they don't choose to take up Agentforce, they can actually explore the option of creating their own agents, which is probably better for the margins of the business in the long run. And that is what the market is pricing in today. The market is pricing in the competition of companies creating their own AI agents, which is bearish for Salesforce. And for Salesforce, at the start of this year, the company was actually trading at a hefty valuation. I believe it was trading at around a 45 times earnings. And even today, the stock seems expensive on a PE ratio perspective. So for Salesforce, what I don't like with the company as well is their acquisitions. So Mark Benioff, which is their CEO, he loves acquisitions. And for example, a few years back, he bought Slack. He overpaid for it. And Slack was meant to compete with Microsoft. But so far, it hasn't done anything yet. And he clearly overpaid massively for this company. So when you have a CEO that is actively trying to push for acquisitions, number one, it could dilute the core business for Salesforce. And number two, your acquisitions, they're not predictable at all. It is a much less predictable way of allocating capital as compared to just buying back the shares or doing dividends. So for Salesforce, this is one part of the business that I don't like. But for all your different software companies, there's a counter argument that can be made. So years of data storage cannot be replicated overnight. Years of workflows and systems cannot be replicated. Years of workflows and systems cannot be replicated as well. So all your different firms that use Salesforce, for example, they have their systems and workflows embedded into Salesforce software already. So it is hard and it will take a very long time for them to switch. And more often than not, the convenience outweighs the cost itself. But for investors today, investors want to see the agent story playing out. And so far, no company in the software space is doing so. I mean, the closest one is Salesforce. And the markets probably fear that all these different software companies will one day be eaten up by agents if they don't innovate and push towards agentic AI. And that is why we're seeing a re-rating for all these different software companies. And for Salesforce valuation today, at its current stock price of around $239, the stock-based comp adjusted free cash flow, the company is still pricing in around a 10% growth over the next 10 years. So for Salesforce, the company is already slowing in growth, so I don't expect them to be able to hold this 10% over the next 10 years. And so for Salesforce, I think the company is still on an expensive side today. I mean, it is trading at a 36 times earnings, at a price to free cash flow of around 25 times. So for me, I think Salesforce is probably still an avoid today. The next stock that I'll be covering is Hermes. So Hermes year to date is down around 11%. It is currently around 30% off of its highs. The stock is trading at a 47 times earnings. So for Hermes, if you were to look at the valuation of the company's current valuation is around the median over the past 10 years. So the company traded at a low 30 P ratio before in 2016, and it went all the way up to around a 74 times earnings in 2022. So for Hermes, although the company is a high quality one, at its current valuation today, the company still seems a bit expensive as compared to your normal average S&P 500 company. So for Hermes, why exactly is the company falling? The company is falling because it is seeing decline in terms of growth. So this is Hermes as well as LVMH leather goods revenue growth. LVMH actually recorded a negative 12%. Hermes recorded an 11% growth, but this is a lot lower than what it has seen over the past few years. And that is why the stock is down around 30% from its highs. And for a luxury goods segment, it actually saw a boom post-COVID. So now we're seeing some form of normalization, which is why all these different luxury companies are getting hurt as well. So for Hermes, I think it is a high quality business, but it is still a stock that is a fair bit expensive considering the growth of the company. So the company is probably expected to grow at around 10 to 11% over the next few years. So at its current PE ratio today of around 47 times, the company is still trading at a 4-pack, and that is probably a bit expensive. The company is premium luxury, but there will always be strong pullbacks and drawdowns as well when the economy turns. And it is not 100% recession proof, although some people like to push it online. For Hermes, it is after all in your luxury segment, and even a company like Ferrari experienced an 8% drawdown in terms of the revenue in 2020. So we could see a lot more for a company that sells Birkin bags as compared to a company that targets the top 1% of the top 1% of the richest people in the entire world in Ferrari. Also, a quick plug for myself, if you're interested in supporting the channel, feel free to join this membership program. I just created it and I'm hoping to expand the community here. It's in the description if you're interested. Feel free to sign up if you're interested. The next stock that I'll be covering as well is United Health. So United Health year to date is down around 50%. The company is trading at an 11 times earnings. So for United Health, it is an extremely simple story. I mean, the company is undervalued, massively undervalued. At its current stock price today, and assuming no growth in terms of the free cash flow over the next 10 years, as well as terminally, the company's fair value is at around $278 a share. So that is assuming no growth for the company at all. And historically, the company has grown revenues at between 6 and 10%. So you could expect something similar to what it has seen over the past few years for United Health. So for United Health, even with this conservative estimate, the company is still 10% undervalued. So for me, I think United Health is probably one of the better buys in the market today. So for United Health, your lawsuits are overblown. So what you're seeing online is often exaggerated. So for example, all your different news outlets are trying to push the narrative that United Health is committing Medicare fraud. But what you need to understand is that United Health only holds around 25% market share in that segment. And besides that, your premium adjustments will take place very soon, and that will help to improve the margins for the company and reprice their premium so that they can offset the medical cost that is coming up as well. The next stock that I'll be covering today is Chipotle. So Chipotle year to date is down around 30%. It is currently trading at a 36 times earnings. So for Chipotle, this is their business model. They own their own restaurants. They don't do anything related to franchise, and this helps for quality control. This is what the company has been doing for many, many years. And for Chipotle, the main growth story is simply just the increase in the number of restaurants. So they've been rapidly trying to improve and increase the number of restaurants that they own in the US, which is bullish for the company. And besides that, Chipotle also exerts pricing power. So similar to companies like McDonald's, like Popeyes, Chipotle has actually increased the prices by quite a fair bit over the past 10 years. And so the company's main growth drivers today are foot traffic, pricing, as well as the number of restaurants. But for Chipotle, the problem with the business is that their golden boy, Brian Niccol, is gone. He was the one that rescued the company out of the disaster that they had a few years ago. And currently he's at Starbucks. The company had its first decline in terms of the EPS in many, many years. And for Chipotle, it is a non-franchise business model, so they own all the restaurants that they create. And that suppresses margins, and it is hard to ensure sustainable growth, especially if you're owning all your different restaurants. So if you're to contrast this to a business model like McDonald's or Domino's, those two companies, they operate majority of their business in the franchise portion, which leads to very high margins as well as predictable cash flows coming into the business every single year. So the last stock that I'll be covering today as well is Duolingo. So Duolingo over the past 5 days is down around 2%. It gave back the entire earnings boost, and the stock is currently trading at 140 times earnings. So for Duolingo, the thesis today is an extension of the offerings outside of just language learnings. So if you've seen Joseph Carlson's video, his thesis is that Duolingo will expand outside of just language learnings. They'll move into chess, they'll move into all these different other offerings to try and expand the app to make it an everything app. And the company has very strong social media presence. I mean, they're one of the biggest accounts on TikTok, and the company has seen fast growth as well as higher subscription for the company, which is more predictable in the long run. But for Duolingo, there are a few concerns with the company. First of all, the company is trading at an extremely steep valuation. And although there are similar companies in the past that were trading at hefty valuations like Amazon, it isn't a reason for you to buy into a company that is at 100 times earnings. For Duolingo, if you're to contrast it to all your different software companies that we discussed earlier, it is much easier for AI to disrupt Duolingo because it is easier to shift consumers as compared to enterprises. So that could be one headwind for Duolingo as well. And for Duolingo, there are translation apps coming up. So for example, Google is trying to increase the accessibility to translation. They're incorporating translation into Google Meet into their own Google platform. And this could reduce the number of people that go on this Duolingo app to try and learn translation. So for Duolingo, it is simply a stock that is expensive today. I mean, at 140 times earnings, although the company is growing rapidly, growing revenues at upwards of 30%, I don't think paying 100 times earnings for a company that could be disrupted is a very good decision. So for me, I'll be staying out of this one. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what do you think about Deckers? So Deckers is a company that sells your Deckers shoes, of course. And for Deckers, the company is facing headwinds because of its tariffs. So they have a lot of their factories outside of the US. So they have factories in Vietnam, they have factories in China, they have factories in Sri Lanka as well. And all these different companies, they're facing tariffs from the US. So for Deckers, the top line is actually growing rapidly. I think the company is still in the growth phase. The stock price is getting hit because of all these different tariffs coming into the company. For retail in general, I would avoid them. And in Deckers' case, it is a company that is still growing rapidly. It is probably one of the better ones in your retail space. But for me, I'll be staying out of all these retail companies for now. The next question, it says, have you considered Constellation Software or either of its spin-offs? So Constellation Software is a serial acquirer. It is a company that is probably extremely high quality given their CEO, which is Mark Leonard. So Mark Leonard is an amazing CEO. He is extremely similar to Warren Buffett. He tells his investors when the stock is expensive and his track record shows. But for Constellation Software, the problem with the company is simply just the company is too expensive. You have AI that could threaten all these different software companies. And although they're acquiring mission critical software companies, in the long run, companies with no organic growth is not sustainable. Hopefully you guys have found this one useful and invest safe.